You don't need any other strategy when you know what I'm going to tell you in today's video. This isn't some fantasy or idea. What I'm going to tell you is the facts of the market, and this is the fastest way to become profitable. And this is the truth about the Forex markets from my 7 years of trading experience. So firstly, we're just going to go through the theory so you can understand the why. Then we'll get into the charts and I'll show you exactly how this works so that you can use this information and not only understand the base level, but understand this on a deeper level. So this is our system. This is RIMC. This is how you can understand the narrative of the market and the direction in the market. And you can also use RIMC to take as an entry system to take profit from the market as well, following those higher time frame narratives, because it's the higher time frames that the market is following. The narrative is built from the higher time frame, and the lower time frame builds the delivery to support that direction. Every single high and low in the market is predetermined ahead of time. The market is absolutely perfect and precise, which means that we can be perfect and precise with our entries and understanding. This market is also fractal, which means higher time frame and lower time frame delivery are both a representation of the same data, which is the reason why we have so many time frames, because all we're doing is just zooming in and out of price to get a perspective on the same data. So when we've been on this journey, we've followed the money to understand who's in control. So there is a hierarchy that does control everything. So we need to understand that hierarchy to then understand the markets properly from its perspective. So if we have a look on the screen right now, so this is us, right? We're at the bottom of this food chain. This is that triangle, essentially, is that food chain. We're right at the bottom. We have zero influence on anything that's above what we can currently see. We don't have any influence at all on the people or the planet. We can impact people, of course, but we will not change the system alone. So we need to understand the system so that we can learn to manipulate it in our favor. So when people say things like the market's going to change, or when we figure out smart money, they might change the markets, you need to understand that we are irrelevant. We're never going to change the markets with our ideas. This system is set up so that they can get into the market. It's not set up so that we can get into the market. So it's not about us. It's about them. It's about understanding them and understanding how they move price. So we're right at the bottom. We are irrelevant. No matter how much money that we make from trading, we'll never still be relevant, because these people at the top, they print money from nothing. There is no gold standard anymore. And because there's no gold standard, and because there's no people that actually regulate the people that create price and create money from nothing, they manipulate and control absolutely everything to their desire. So above us, we have government. This is what most people think is the top of the food chain. They never really think past the government and the people, because the government tell the people what to do, the people do it. You know, people vote and they vote for their government, and they believe that that's the people that's going to change the world, and so on and so on, and change all their areas. It's just all a load of rubbish in my opinion. The government don't really control anything. They are just an entity to control the people, and they are an entity that listens to the people that's above them. And the government does not have much money. If the government wants money, they have to go to the central bank. They have to get a loan. That is why the debt is so big, and it's going to stay big forever, because they consistently go back to the central bank, loan money from the central bank, and guess who pays it back? All the people right at the bottom. And that's why we have taxes. It's a way of the big banks and the central banks and the people at the top to stay in control of the people by continuing to tax people. So above the government, we have the corporations. So the corporations, I would say, probably have the biggest influence on the people. These corporations control the minds of people a lot more than the government. I'd say these corporations are people like the news, for example. The corporations are also your favorite biggest brands. The system and how it works, the government and the corporations, these will be the people that have the biggest impact on their lives, because they don't truly understand how this system works. Now, above the corporations, we have the big banks. Now, everything above the big banks, I believe, controls these bottom three with money, so that they can have the biggest influence on the people right at the bottom. And because the people at the bottom are the masses, they are the majority, the people at the top are the minority, they need to understand a way to create a system that controls the people at the bottom, so that the people at the bottom consistently go to work, make money, pay taxes, and the system continues to repeat over and over again. So if we go back to the big banks, these will be people like JP Morgan, Citibank, so on and so on. These are the people that have the capital to move the markets. Now, I believe from my experience that the central banks and the big banks, these both work together. I think the central banks have an algorithm that allows the big banks to get into the market and move the price in the direction and manipulate the price in the direction that they want to manipulate price. And I believe this is how that they control the money supply. This is how they control the markets. So these are the entities that are essentially most important to us, the central bank's algorithm and the big banks, because the central bank algorithm will always set up price in a way that the big banks can enter into the market and move price in the direction that they want to move it. So it's not about us, it's about how the big banks are entering into the market and how price is being set up using the central bank's algorithm for them to get involved in the market. Now, when we talk about RIMC, that's understanding that ranges are created, which is where big banks enter their orders into the market. And because they have such big orders, they have to enter small ones over a longer period of time to not create just a massive movement in the market. Then they initiate price, which is the second part of RIMC. That shows the intention of the orders created into that market. Then when they come back into that previous orders, that's the mitigation phase. And then the true intention is the continuation phase of RIMC. That's where we see that biggest move. That's where we see those explosions in price. So that's what we want to follow, and that's what we want to look to get involved in. And this is the repeatable pattern that they use to enter into the markets and control the price and manipulate the price as well. So again, you can go even further above this, and this is where you go into the quote unquote conspiracies. But for me, I believe all of that stuff is true. That's where we go into the financial elite. That's where we understand how the world is manipulated and controlled, not just the money systems. Essentially, if you control the money and if you control what people's mortgages are and car payments and cost of living and so on and so on, if you control all of these things for the people at the bottom, you do control the world, because you influence and control people's minds, and this is how they do it. So you can look into all the financial elite. Essentially, it's just a bunch of families that do control the money supply and also control the narrative and the direction of the world and how people think and where the world is going. So you can do your own research for this if you would like, but the most important parts to us is those central banks and the big banks. And it's really about understanding how these two work together in order to move price. What I'm going to show you now is how to read the market from the bank's perspective on the charts, how you can predict the moves using the facts, and how you can use a repeatable entry system to trade these moves with 1 to 10 risk to rewards. So back to the charts. We're starting here on the 15-minute chart. This is considered a higher time frame chart because we're trading intraday. Obviously, there is other higher time frames as well, and we're thinking about weekly, daily, and so on and so on. When I'm building a trade idea or understanding where the direction of price is at this current point, I'm going to use the 15-minute, and then I'm going to go down to the 1 minute, and I'm going to correlate the 15 and the 1 minute together. This way, I can take trades in good locations based on the 15-minute chart and the 1 minute chart, and that's going to increase the probability of the trade. So just looking at price, there's a couple of different ways that you can look at price. We have a sideways range here. That's a representation of orders being created into the market. They initiate price to the downside. So we know that when price comes back into this area, this sideways range, this is where we want to see price reacting out from, right? Every time price comes back into this area, this is an opportunity for us to get involved in that continuation move. Range initiation creates the low, mitigation, continuation, and we target that low here to the downside. So as we can see, it's very much about timing as well. When we know we're going to get moves in London or New York, this is where we want to be looking at the chart at these points of mitigation, because this is also going to increase the probability of this playing out as well. So we can see that price created that range initiation. We're coming back into that point of mitigation, anticipating that continuation phase. Now, we don't just trade this based on the reaction with our stop above the high, because then we're guessing. What we can do is zoom into this price delivery here and look for that same range initiation, mitigation, continuation price delivery, and then we can trade alongside that momentum to the downside, and we can get in with tighter stops and get bigger risk rewards out the market. I'll dive into price, into this point and into this location here in a second, but I'm just going to give you an understanding of how to read the price using our concept and our framework. So again, price is contained sideways here. We initiate to the upside. Now, what a lot of trend traders do is they look at this low, they look at this high, they're looking to play that pullback and continuation. Now, you can see that that's a great way to trade because you're always trading at good locations. But when price is contained in a sideways range, you're consistently getting tapped into the trade and then taken out. And it's the same again when you do it on the other side. When we get a A to B movement, you're always against that momentum because you're always just looking for that A to B movement. When you understand that price is inside a sideways range, you understand that every single range inside the sideways range has to be reacted out from. And when swing highs and swing lows are taken out in the market, These are those opportunities for new orders to be created in the market. And this is how a sideways range is created, and this is how it moves. And it's all about taking trades in good locations at the edges when price is contained in a sideways range. So obviously at this point of mitigation, we don't know that price is inside a sideways range. So what we can do, instead of just trying to trade it as a reaction and a reversal, we can wait for the momentum on the lower time frame and then trade alongside that momentum to the downside. Now, a lot of people might be asking, well, there's a range here. You know, why aren't you looking for range, initiation, mitigation, continuation here? When we think about the location of price, this is in the middle of the range. We want to be trading towards the edges because these are going to give us our highest probability trading locations, and we want to stay away from the middle of the range. This is low quality positions. Ranges or liquidity that's created middle of the range is going to be used for liquidity and to support a move from the edge or after the swing. So as we can see here, we did react from the edge, and this might have been a great opportunity to play that continuation. So you maybe would have got involved in something like this on the lower time frame as a continuation, and you may have taken a break even from that trade. But if you were trading alongside this intention, there was so much opportunity to get involved in that move, and we will dive into this in a second, like I said as well. Now we move on to the next day. What do we get? We run the swing low. That gives an opportunity for a new intention to come into the market. And when I say new intention, we see the intention created. Sideways range, initiation, that forms the first part of the price delivery. This is orders being created into the market. This is the intention of those orders, which creates this high. When we pull back into that sideways range, we know that this needs to be reacted out from. That is our mitigation point. This is where we zoom in here and play our continuation phase to the upside using RIMC again to target this high. And like I said, highs that are created at 50% of the range become liquidity. So that became an easy target. And again, we'll go down onto the lower time frame. This was during London session. Both of these opportunities were during London session. We'll dive into both of these in a second. Then we move on to the next day, right? So we can see that price has seen that continuation now. We're not in a range anymore. We're in that bullish trend. We get that higher low, we get that higher high, we break structure showing that intention. Now, again, we're looking at good locations. We want to only look for buy low locations inside this range, but we can also trade this intraday price delivery as we're seeing here. So we can see price reacts from the buy order. Again, orders are created inside the sideways range. We initiate, that shows the intention. This is like having the cheat code of the market, knowing the intention so that when price gets back down into this point of mitigation and we see range, initiation, mitigation, continuation on the lower time frame, we're trading alongside that intention after the price has showed its intention again in the market. So it's like having that cheat code. It's like understanding what's going to happen before it even happens. And it's all just about picking good locations in the market to trade away from, and then going down onto the lower time frame and trading with the intention on the lower time frame. And that's how you're able to get those 1 to 10 risk to rewards, 1 to 15s and 1 to 20s. So now what we're going to do is we're going to go down into the market now, and we're going to look at these points of mitigation. I'm going to show you how you can use our repeatable framework to get involved in great opportunities into the market. Okay, so I'm down on the 1 minute chart. This is a location that we will be looking at, and also we're coming into London session where we expect moves to happen. I've just zoomed out so you can see that same sideways range that we were looking at before. We know orders are inside this sideways range, so when price comes back into this location, we expect price to react out. Now, the reactions can happen and we could still stay bullish and see continuation, but it's when price changes to bearish momentum on the lower time frame that we know that this intention might be playing out that was created inside this sideways range here. So that's what we always want to look for, the intention to be shown, and then we trade alongside that intention on the lower time frame. So now let's zoom into price. Obviously we're coming into London session, like I said, so it's just about reading price and reading the intention. Now, if you wanted to trade this right at the top, we can very clearly see we got sideways range, initiation, mitigation, continuation. Now, if you didn't want to trade that right at the top, you could also just wait for some intention to be shown, a structure to be broken, and then you can trade alongside that intention to the downside there as well. So let's just play this on. What can we see? We can see that structure's broken here to the downside. That is showing the intention of lower prices at this point. And what do we see? We have a FU wick inside a sideways range. Remember, it's about understanding bearish order flow at this point. We have the sideways range, we have the initiation to the downside, we pull back into this range, and then we get that continuation. Now, you could trade this at 50% of the range, stop above the high, and still have a 3-pip stop. And like I said, because we're playing that higher time frame intention, we expect that the low that was created way down here will become that next target for that range, initiation, mitigation, continuation. Now, you can see that that's a 1 to 17 target. That's a potential. We focus on 1 to 10s in NJAT. so that we can trade using a sustainable system. Now, that would have been your first opportunity to get involved in this move, and obviously that would have played out for a continuation to the downside. And then as we can see, price continues here to the downside. So we get another range initiation, mitigation, continuation. So you don't just get one opportunity, you get another sideways range created here. We get an initiation to the downside. Again, that shows the intention. When it pulls back into this sideways range, this is your opportunity to get involved in that range, initiation, mitigation, continuation, opportunity to the downside. And all we're doing is just following the higher time frame momentum. We can see that the higher time frame is what is driving price. It's the lower time frame that's giving us our opportunities to get involved in that drive in price. So this would have been another opportunity you could have got involved in. Now, if you didn't get involved in that, let's see if there was any more opportunities that you could have taken. And as we see, the same again, we get another sideways range that was created here. We get an initiation to the downside. That breaks structure, showing the intention of lower prices again. Nothing's changed. When we pull back up into this range, this is your opportunity to get involved with a stop above the high. So you can see there's just an abundance of opportunities when you understand how to trade in this way. And there's so many trades on a daily basis that you can get involved in. We focus on one session, which is London or New York session, so that you can come prepared and focused to your session and have a great performance. Now let's go back to the 15-minute chart. Again, I'm not going to show you every single risk to reward here. You can very clearly see a lot of these are opportunities to play out and hit 1 to 10s. So let's go back onto the 15-minute chart and let's build the narrative for the next day. So as we can see now, that was that continuation move that we were just looking at on the 1-minute chart. As we see, we get that continuation to the downside. We take out the swing low. Now price is very clearly in a bearish range. And I say we're in a range because we haven't created an A to B and a higher low and a higher high. So we're not in trend. If we're not in trend, we have to be in a sideways range, which means now I can look for the highest point, which is here, and the lowest point created, and I can have my price range inside this sideways range at this point. So now I know that if price is down here, we're at buy low locations to play buy opportunities in the market. So every time price comes back into the edges, these are opportunities to take either buys or sells. And because we're at a higher time frame mitigation, which is a sideways range, initiation, prices come back into here in the future. Now that's our opportunity to understand the intention of this range, which is then to create higher prices in the market. So when we're seeing bullish order flow created and we're at good locations, we know that we can zoom in on the lower time frame and trade alongside the higher time frame intention that's being shown on multiple time frames. And this is how you stack your confluence in the market. This is how you get better at trading and you take high probability positions. So let's go back into the next day now. So we can very clearly see price took out the swing low here. This was during New York session. And like I said, we focus on sessions. Chuck's mainly focuses on London session. And we have a whole trade floor dedicated to London session and learning in the moment. And we also have a New York trading floor, which is also dedicated to learning in the moment, so that you can ask any questions that you have on current price. And we can learn to read and understand on a daily basis. We don't backtest. We make sure that we always focus on live price, because that's the skill that you need to build in order to become a great trader. So as we can see, we run the swing low, opportunity for a new intention to come into the market, as we can see here. So when we run those swing highs and swing lows, this is where we want to be looking to trade on the opposite sides. So let's dive into the lower time frame here and just see the sort of delivery that we got. So I've just zoomed out now, so you can just see when we run that swing low, the sort of price delivery. And as we can see, all we're doing now is looking for bullish order flow. We're using our same framework, right? So we have to understand firstly that price is contained in a sideways range. When price is contained in a sideways range, we haven't got a trend. So you can see that we have got that lower time frame trend. That is correct in the market. We are getting those higher lows and higher highs, but overall price is contained sideways at this point. So again, all we want to do is add on our same framework that we used before, find the highest point and find the lowest point. And now all we're going to be doing is looking to buy low in this sideways range. We already have our direction. So now we're just looking for ranges created at a low price. And the only sideways range that we have is this one here, sideways range before price initiated. Now you could say that price has come back in and mitigated out and seen continuation. It doesn't matter when we're looking at good locations. Price will react out of ranges at good locations multiple times. So you can see now that we also created highs at a low price. And I say they're at a low price because this is the 50% of the range on the M15 chart. So highs created at a low price can become targets following that bullish intention. So now we're starting to stack the confluences together. All we're doing now is waiting for price to get down into this area, and this is where we can look for those buy opportunities here as well. So we can play this same sideways range here, that we have. I'm just picking the edge, which is here. Goes underneath the low. That gives you a safe stop so that if this trade doesn't play out and you are wrong, so be it, then you move on to the next trade. But this is the safest place to put your stop loss if your trade plays out, because they'll never push price lower than the sideways range. So as we can see, price comes back down into that point of mitigation. You would see that reaction from price as well. We get a strong rejection of lower prices at that point of mitigation. And obviously we get the FU wick as well. That is a representation of a buy order being created in the market as well. So it's about understanding and reading the price delivery as we're getting into the trade. And also we can see, remember when I said highs are created at 50%, they become liquidity following that bullish intention. So we've set up liquidity at 50% of this sideways range that we have on the lower time frame as well. Now that can become the liquidity following that intention of higher prices. So this trade ended up being a break even. Obviously our risk to rewards are 1 to 10s. You can see that you've got another opportunity to play that range initiation, mitigation, continuation, sideways range initiation, broke structure, shows the intention. When we pull back into that range, you've got another opportunity to play that move if you didn't get the first one. And then we see continuation to the upside. Now, because I said our risk to rewards are 1 to 10s, this one didn't end up playing out for a 1 to 10. You would have hit a 1 to 8 and it would have come back to take you out for break even. But that's just a part of the game. That is a part of having larger risk to rewards. You just have to accept that. And we only need 2 out of 10 to win to make double-digit percentage results. So you can see, because we have the precision in the markets, we don't need to have massive stops, which means that we can get higher risk to rewards, which also means our win rate doesn't have to be so high as well. So what I'm going to do is go back to the 15-minute chart. Obviously, you can see that, this trade ended up breaking structure to the upside, would have taken you out for break even. But what we're going to do is go on to the next opportunity. And this is just 1 day worth of price delivery, right? We've had multiple 1 to 10 opportunities in London session, and we had 2 more opportunities in New York to play continuations back to the upside. It's really about understanding the higher time frame, understanding the location, understanding how ranges are created, and then trading alongside those intentions. So remember what I said, we're using the 15-minute and the 1 minute together. We can see that that range that we played yesterday actually created that higher time frame range and showed the intention of higher prices. So remember, I said we used the 15-minute and the 1 together. So we created that low, created that high. We have a sideways range that's stacked down here. So we know that this is where the orders are created in the market. We see the initiation that shows the intention of price. We create a high here, middle of the range. And like I said, highs that are created at the middle of the range become liquidity following that intention. So when price came back down into this point of mitigation, and now we're in that continuation phase of price, which is that next aggressive move in the market, this is where we want to go down to the lower time frames during our session and look for those opportunities in price as well. So let's do that right now. So now I'm just zooming out so you can see that sideways range represented. Again, this is the area that price is going to react from. We can read the exact points inside this range where we have sell to buys, which are representations of OBs in the market. So we can pick the specific point, but we don't have to. We can just trade alongside the momentum once price breaks the structure, and then we can look for our range initiation, mitigation, continuation pattern, which is bullish order flow, which shows that price wants to move higher and creates structure in the market as well. So let's just play this forward. Obviously now London session has started. We see the manipulation below the low. Now it's about looking for price to break this structure high as we see here, and then trading alongside that momentum to the upside. So let's play it forward now. We can see that price is now broken structure to the upside. So we're now bullish in the market here. So we wait for that break of structure first. Then we look for our RIMC pattern. What can we see now? Price is creating a sideways range here. So we know orders are being created in the market. We know how to read the bank's orders. These are the facts of the market. When we break out of this sideways range, like we see here, we're now waiting for price to pull back into the sideways range now, and then we can play that intention of higher prices in the market. So we got range initiation. When price pulls back into this range, that's our opportunity to get involved. So you can either trade this as a limit order, or you can wait for price to come into this point of mitigation, and then you can trade alongside that. As always, we use 1 to 10 risk to rewards. So now it's just about waiting for price to pull back into this location to play that continuation to the upside. This is the setup, right? So we see price pulls back, you get tagged into the trade. We create weak highs here. Again, multiple rejections in the same area. All of these highs that are created here, they're all created at a low price on the higher time frame. If we just zoom out and have a look at that. So because we're in that massive sideways range, this high is created at the 50%. And remember, we're playing alongside range initiation, mitigation. We're in that continuation leg to target this high. All of these highs are created at a low price, which again is just becomes liquidity following that intention to the upside. Now, as we see again, this trade plays out, so it's just more and more opportunities every single day to get involved in these moves to the upside. If you didn't get involved in them, then there's plenty more opportunities as well to get involved in moves throughout the day. But we are just focused on one session. We're looking for our setup during the session, and then we're getting involved in these moves in high probability locations, trading the facts of the market. So let's go back to the 15-minute. And as we can see on the 15-minute chart, right, we've taken trades at good locations. This has been a sell high. These were buy low locations, and these were buy low locations again. We stayed away from the middle of the range. Middle of the range is where the slaughterhouse is. That's where you get tagged in and out of positions a lot. We took trades at good locations, following the intention of the big banks. When they showed their intention, we got involved in that continuation of that move. And this is how you get into high probability trades. This is how you use the facts of the market to take 1 to 10 risk to rewards, and look at the abundance of trades. This is just 2 days worth of price delivery that I've shown you on one currency pair. This is what we do. We focus on one currency pair. We get involved in great opportunities on a daily basis, following the intentions of the people that matter. Thank you all for watching. If you want to find out more about how we trade these markets with precision, visit our website at notjustatrade.com. You can also find us on Instagram at notjustatrade. Feel free to join our public Discord in the link of the description of this video, and we'll catch you on the next video.